Mike and Will here to give you a market update, give you some perspective on the Fed's actions, the size and the scope of them, the fiscal relief package that we're still waiting for to be voted on to be final. Give an update on COVID-19 and answer some questions we're getting. So we first start with the market update. Over the last several days, there's been quite a bit of volatility, as we've seen and expected, relative to the response of the Fed and to the lack of fiscal package being implemented and voted on here. So I think, Mike, to start off, we were down quite a bit on Monday. Today, on Tuesday, we're rallying back with a pretty good rally. The first question we're getting is this the bottom or is this a bear market rally? Where are we?
Yeah. So last Friday, that was sort of a disappointing session where we traded lower and broke through that low on the S&P 500 from December 24th, 2018. That low was 2351. Mm-hmm. So Sunday night, futures hit limit down. Monday morning, the Fed announced what we're going to talk about. It's tough to even say what it's called yet. QE Unlimited, QE Infinity, they're buying everything. And we saw the futures reverse pretty hard. So going from limit down 5% to we opened up 2.5% and then ultimately drifted lower throughout the day. So if you're thinking about that technical level of 2351, as we're sitting here today, we're above that. We're back above that. So it's difficult to say, take into account 2351, the stock market was only there for one day in December. So it's not sort of a battle-tested low. Mm-hmm. The other thing to take into consideration is the fact that we went through that, given the amount of volatility we've had, it could really just be noise. Mm-hmm. The fact that we're back above that today could show that violation of the December 2018 low was truly just noise. And then the last thing is, we would love to call this a bottom, but the fact of the matter is we haven't had two straight up days.
There's still a lot of uncertainty out there with respect to the fiscal package. A lot of what the Fed has announced isn't even up and running yet. So we're still at an early stage in this.
We're talking about a much bigger fiscal stimulus package than we were a week ago. So that's nice. Much more significant Fed accommodation. Mm-hmm. And then the last thing is we're finally, yesterday and today, starting to see some signs of life in corporate credit, which, we've had days during this bear market where the S&P 500 has rallied, but it has been a steady bleed in corporate credit markets. And to finally see some signs of life, the LQD, which is the largest investment grade bond ETF, had a record day of inflows.
Right.
So that is definitely encouraging. That could lead you to believe, hey, this has more signs of being a bottom than past rallies during this bear market.
All right. So, Mike, we'd like to take a look at the Fed's response so far. So maybe if you could just give us perspective on all the things they have done and then help us understand the scope of this, because it is massive.
Yeah, it's unparalleled in terms of magnitude and speed. The Fed is increasing the size of their balance sheet so rapidly, far quicker than they did in 2008. They started this crisis with just over $4 trillion in assets on their balance sheet. It would not be surprising at all if, by the end of this year, they were potentially up near 10 trillion. So, listing the alphabet soup and all of the measures that have been taken, the first thing they did was cut interest rates all the way down to zero. Repo, so repurchase agreements, repo funding that started to get strained last fall. That was one of the first things they took care of. They're willing to do $1 trillion of repo funding daily now. 500 billion in the morning, 500 billion in the afternoon. They're not getting anywhere near that level of demand, thankfully.
Right.
But if they were to get over $1 trillion in a day, they would meet that demand. So all of these facilities, everything that's happened, this used to be, you'd heard QE Infinity passed around, which just implied this will be going on forever. This is QE Unlimited, meaning a lot of these are not capped. The Fed will provide as much stimulus as necessary, as much as the market demands in any given day.
Mm-hmm.
So after repo funding, then they relaunched full quantitative easing. So not just buying treasury bills, but buying across the treasury curve and buying mortgage-backed securities. This week they're planning to do 600 billion.
This week. Yeah.
Just this week.
Yeah.
So you're talking 75 billion in treasuries, 50 billion in mortgage-backed securities every day. But once again, they can do more than that in any given day. They are not capping it out. If they need to do 100 billion in treasuries or mortgage-backed in a day, they will.
Right.
And those were a lot of the tools that investors were familiar with in the post-financial crisis period to recently.
Mm-hmm.
Then you get the alphabet soup of special purpose vehicles. You put these things together, and this is QE on demand. We don't know exactly how much support is going to come through each of these vehicles, but it will literally be as much as the market needs. So it leaves out everything but stocks. That's it.
Yeah,
that's the last thing.
So far, right? Yeah, and I think so put that into perspective for the average person watching this. Like they don't see this activity, but the confidence that this brings to the fixed income market, the lending market, is unparalleled. And basically, the things that have gone on behind the scenes that nobody really has heard of, like there have been hedge funds that have gone under already. There have been mortgage REITs that have exploded, and none of these have made any headlines because they've just been taken care of. Relative to what happened during the financial crisis when these things were really causing panic, the banking system is fully supported.
Yeah. That's exactly right. That's a big difference between this time and last time is the transmission mechanism for a lot of these easing measures is the banking system.
Right.
And so if the Fed's doing all of this stimulus, but the banking system is not healthy enough to carry it out, then it doesn't transmit into the real economy. This time around, there haven't been any questions about solvency of major financial institutions or banks. So that's been great.
Yeah.
The other thing of note, and this will be weaved into the fiscal stimulus package, is the Main Street Business Lending Program.
Mm-hmm.
So recognizing, to your point, a lot of folks on Main Street may not see the impact of this. And a lot of this is targeted primarily at large investment grade companies and municipalities. This is providing lending support to small and medium-sized enterprises to allow them to hopefully continue to keep their payroll as we get through this. And so the details are forthcoming and the size is forthcoming. It will be in partnership with the Treasury, backed by the Treasury, and then effectively levered up by the Fed. But this is,
it's enormous.
The size of this package is literally unparalleled.
Yeah. So let's sort of shift gears and talk about the fiscal package. So here on Tuesday, it's been a busy couple of days. The Senate package basically couldn't get through. The House has proposed a new package worth over $2.5 trillion. And there's a lot of good stuff in here to support the fiscal side. Maybe walk us through that and give us some details there and what we can expect and when we can expect that'll be passed.
So they're currently working on details. The expectation is a vote tonight, if not tomorrow. And we're talking about a much bigger package than we were just last week. Now $2.5 trillion. So direct payments to individuals are still in the package, and those have increased. Things that had previously been mentioned: no cost sharing for coronavirus vaccines and treatments, expanded access to paid family medical leave, $500 billion in grants for interest-free loans to small businesses. There's a lot in this package that is going to more directly impact Main Street and more directly impact the people, the individuals who, this is ultimately going to be an employment crisis, a health crisis and an employment crisis. And this can definitely help those folks that either businesses that want to keep their payroll and are struggling to do so, or unfortunately those that have lost their jobs and are looking for a chance to pay their bills and a way to pay their bills. So, and this will be, hopefully it will be quick. That's the thing. It has to be quick, right? Because we know the employment situation is deteriorating right now.
Yeah, the headline is awesome. The details are what's going to really give the market support or not. And we have to understand how this is all going to be rolled out, how quickly it's going to be rolled out, and what the real impact is to get money to the people who need it the most. The news in some countries is improving. The news here is still, the cases are still on the uptick as we expected. We've got some graphs we wanted to sort of talk through and discuss, but give us a quick update on COVID-19.
Yeah, when we outlined sort of the known unknowns and what the consensus was for peak case counts in the US, haven't heard anything that would suggest it's going to be worse than that. Haven't heard anything that suggests it's going to be better than that. So the consensus is still that cases should be peaking in the US somewhere around the 6 to 8 week time frame. And any vaccine, even if it were expedited, would take anywhere from 12 to 18 months to pan out. There has been some good news flow, though, which is quite a shift. Hearing that in Wuhan, self-isolation bans are being or enforcements are being lifted effective April 8th. And we're hearing from a lot of companies that Chinese manufacturing and production activity is anywhere from 75% to 90% back up and running. So that's been very encouraging because it shows if you do this social distancing effectively, we can get back up and running and things can hopefully return to business as usual. So that's been somewhat encouraging. And then also seeing Italy, which was the epicenter of the outbreak in Europe, finally starting to see some type of positive impact from social distancing and isolation enforcement, and finally seeing the case count and death count fall, which is good to see there as well.
Right. And we threw up this graphic of confirmed cases, total confirmed cases in various countries, the bigger countries that have been impacted by this. And you can see sort of how the curves are starting to peak in certain areas. Some areas have done considerably better than others. Singapore, South Korea, they've definitely been successful at sort of flattening the curve, to use the term that's in the media quite a bit. And you can see where we are relative to that and to other countries here. One of the emerging narratives that I think just recently, as I think I noticed it yesterday afternoon when the administration held their press conference, the emerging narrative of sort of the virus, we can't let the cure be worse than the virus. We've got to get people back sooner rather than later. And so we have this other graphic that Johns Hopkins put out relative to the capacity of the healthcare system and flattening the curve versus just letting the infection run. And the new narrative that is being forced out there is let's get back to work faster. So we wanted to sort of illustrate that. This is a great way to illustrate. You let the virus just run its course and peak out, or you try to slow the spread.
Yeah. And this is somewhat of a divisive issue because there is no good option.
No, neither
right?
are good.
This is going to be an employment crisis and a healthcare crisis, and it's take your pick. If you let it run its course, then it's going to be more of a healthcare crisis than it is an employment crisis. And we've also seen, for example, in Italy, where if you get to the point where the health system is compromised and the number of cases exceeds capacity, you naturally are going to see higher mortality rates, higher fatality rates, because doctors just can't handle the cases and provide the care they need. So that's a bad option. Versus the other option is, let's do this social distancing, let's shut down the economy, let's flatten the curve. Well, the economic impact of that is potentially going to be more severe, and the number of jobs lost will be more significant. So it's pick your poison. There is no good answer to this. Yeah.
And the market the narrative in the market seems to be shifting from the impact of the virus to how much economic damage is going to be done inevitably, and how long will that damage persist. And that really is, I think we've started to see more discussion on that front versus how bad will the virus get. Everyone sort of seems to have discounted that we're going to keep seeing cases rise for the next 6 to 8 weeks, and we'll get through it. But now, how much economic damage will there be? And that sort of affects the probabilities of outcomes as where we go from here from a market perspective. So Mike, so we've looked at drawdown and recoveries, and can we put some numbers behind what we can expect from recoveries in terms of returns from here?
Yeah. So reinforcing the idea, it's too soon to tell if Monday was the bottom.
Right.
We'll see, but this drawdown is already on par with 1987 with Black Monday. So in its severity, it's already very bad, and it's probably to the point where additional losses shouldn't be that much more significant. These things have a way of sort of burning themselves out. So you just take the perspective, all right, let's assume Monday was the bottom. And let's assume that the S&P 500 takes almost 5 years to recover its losses. Now that almost 5 years number, that comes from the longest recovery period we've had in the modern era from one of these drawdowns, which was after the tech bubble and after 9/11. So if over the next 5 years we climb our way back to all-time highs, the highs we had on February 19th, that would mean an 11% annualized price return on the S&P 500 from here.
Right.
So, we keep reinforcing, let's take a long-term perspective. We know what's happened. We know about the known knowns. We know this is, if this is a buying opportunity, it's an ugly one, but it's a buying opportunity. Let's just think about what are our opportunities going forward. And you compare an 11% annualized return for buying U.S. equities versus what you can get in cash right now, which is zero.
Right.
And what you can get in high quality bonds, which are really the only two things that have held up well during this drawdown. High quality bonds, things like treasuries, those should probably get you something like zero during this recovery.
Right.
They're, once again, just reinforcing there really is no alternative at this point. It's just having the grit and the perseverance and maintaining that long-term perspective to get through this, because going forward, stocks really are the only game in town at this point.
And finding high quality dividend paying stocks will help you smooth out that ride from a volatility standpoint. What if we recover over 3 years? What do the returns look like?
Yeah, it just gets better from there. So if you recover over 3 years, you're talking about 17% annualized returns. And then the average U and L-shaped drawdown since 1960, we recover in a little over 1 year, 1.2 years. So that would be over 40% annualized returns over that time period. So far superior return expectations than anything we have for safe havens, cash, or high quality bonds.
So the question we get a lot is this the bottom? Should we be going all in now? And to answer that question again, we don't know for certain, right?
Yeah.
So what should you as an investor be thinking about right now?
So definitely thinking about time horizon, thinking about how these things normally play out when you have a shock to the system like this. The volatility on the way up is going to be just as volatile as on the way down, and it's going to be emotional. I mean, the market right now on a daily basis is moving, 6 to 12 months in a day,
right,
based on how it was previously trading. So try not to get too enthusiastic when we have big up days like this, and try not to get too down and emotional when we have big down days like we had on Monday. This is what a bottoming process looks like. Just focus on your time horizon, focus on the long-term perspective, focus on companies that are going to be around, and really focus on income, because that, if anything is scarce these days, it's income.
All right. So that's our update for Tuesday. We'll be back in a couple days to give you another update. We're committed to bringing you regular updates, so check back on our YouTube channel. We'll be back in a couple days with more updates. And in the meantime, if you have any questions or want to have discussions, please reach out to us. Thanks, Mike. We'll talk to you soon.
Thank you.